Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? I'm here to talk today about stocks. Here to talk about some research we're doing on using the Nasdaq versus the S&P 500. So, first off, what's the difference between the Nasdaq and the S&P 500? Well, simply put, the Nasdaq is the top 100 stocks in the Nasdaq Composite Index. So if you were to go Nasdaq Composite Index, you'd see over the past year it's down, so it's very, very red. You would see that it moves a lot, so it's very volatile. And hopefully we can get a feel for who's in it. What stocks are in the Nasdaq 100? Not always easy to find. But if you go into Wikipedia, you can get all this information. I think it's great. So Nasdaq 100. So that's one way to invest. These are the tech stocks. The second way to invest is using the S&P 500. So we'll type S&P 500 index. You can see this over the year is also red, but actually it's a lot less volatile, a lot less movement in the S&P 500. And let's see if we can find information about maybe what stocks are in it. And maybe some information, right? Here's a fact sheet. Not really looking for other currencies, right? Looking for US dollars. Wow, there's a lot of fact sheets there. They have hedged fact sheets, so that's not exactly what I'm looking for. But it is a capitalization weighted fund. So interestingly enough, not a lot of info, right? So we'll try again. Nasdaq Composite Index. Let's see if we can find some info. No, not a lot of info. So, always interesting, right? These are the major indices, and yet you can't find much out. And so, today in the Chicago Quantum Net Score, we have an alternative investment opportunity for clients, which are hedged funds. They're actually managed accounts that are managed separately and held with our custodian, but we manage them together so all the accounts get all the same trades relative to the amount of money that they have. And so we do this, and today we do this process based on the S&P 500, specifically based on the SPDR, the SPY, which is the ETF. And so this thing that we do is based on a run that's based on the S&P 500. Now, this is inside baseball, as I always like to say. This is the actual results of the run. So I'm going to show you what I found. First thing is the variance of the S&P 500 is 2.1 times 10 to the negative 4. When we look at the run for the QQQ, you'll see we use the QQQ as the market index. This is through yesterday. This is through Friday, market close. The variance is 3.8 times 10 to the negative 4. 2.1, 3.8. That's a significant difference. That's almost double the variance. That's crazy, right? So that means a lot more movement, up and down, variance. Variance, think of, not smooth. So the next question is, what does that variance cost you? Because, they say no risk, no reward. Risk equals reward. More risk, less reward. No. More risk, more reward So how does it all work? Jeffrey, what are you doing here? What are you talking about? Help me out. So the S&P 500 has an actual return, not including dividends, which is about 1.3%. So figure it's a 17% return for the S&P 500. So 2.14 times 10 to the minus 4, and 17% return. Now let's look at the QQQ. 3.77 times 10 to the minus 4, so it's much higher, and the return is negative 32.26. Now, the Nasdaq pays a smaller dividend. It's about less than 1%, so figure we're just going to call it minus 31.5. Return is 31.5. And these are negative returns, not positive returns. Here and here. So the question is there some way to like normalize this, right? So if I divide, I'm getting my handy calculator here on my phone. If I can divide 2.14 divided by 0.17, I get 12.6. And on this one, if I can divide 3.77 divided by 0.315, I get a roughly 12. So you could basically round it and say that it's the same, right? It's like 11.97. It's 12. So your return is lower because your risk is higher, because the expected return isn't yesterday's return, it's tomorrow's. So now, big question I asked myself for like a month, which is, should we be basing our model, our optimized portfolio on the S&P 500 with more attractive variance, most attractive return, or should I base it on the QQQ, which has the most variance and the least attractive return? Now you can think about what's in those indices, but there's a lot of overlap. And so one's more tech, one's more Main Street, but realistically, a lot of overlap, right? So I said, let's try it both ways. I don't know, right? I don't know. We'll use the same market assumptions. 9% return on risk, 4.25%, 9% minimum return on risk assets, 4.25% risk-free. 9% market floor, 4.25% risk-free. $400 million market cap of any individual stock. We get a bunch of dogs there. I don't like it. But when you look at it, the expected return if you use the S&P 500 is 9.12%. The expected return if you use the QQQ, 7.7%. So if you base your market work on the QQQ, lower return. Now, what does that mean? Well, the model balances risk and return. And so if there's less expected return, you have to have a greater weight on risk. And so I would expect to see lower risk, lower return. So when we look at the answer, and I'm just going to jump to the answer here for you. Please don't get agita from all this scrolling. Here we go. The best portfolio found has 37 stocks in it. The score is, and basically the score is always 0 for the whole market. So, and negative is good. So, you 55 ticks is your score for 37 stocks. Okay? That's great, Jeffrey. Thanks. Really appreciate it. 37 ticks. I'm sorry, 55 ticks, 37 stocks. Now let's look at the same thing using the S&P 500. Jeffrey, is it different? You hear my cat meowing. Cat knows. Cat's been hearing me talk about it all day. 51 ticks using the S&P 500, 19 stocks. So, it's a different answer. It's roughly the same edge, but it's gathered in a much different way. So, if you use the QQQ, knowing that there's more risk, knowing that the prices have come down in order to account for that increased volatility, there you go. So, 37 stocks, same edge as 19 stocks. And in fact, when you look at the stocks, I have a note here that'll probably be helpful. So Jeffrey, what was the difference? I don't know what that crap is. Get rid of that. Here we go. Hang on. So for all the stocks we looked at today, the difference was the S&P 500 and the QQQ agree on 12 of the stocks, so 12 of the 19. The Spider has, but the QQQ does not, 10 stocks. Now that's using Friday's data, Friday's best portfolio. QQQ has, but SPY doesn't, 17. So if you use the QQQ, which is a riskier return, you're adding 17 brand new stocks to the party. If you use the S&P 500, you're adding 10 stocks to the party, and they both agree on 12 stocks. So think of core portfolio and then 10 versus 17. Now if you look at some of those 17 stocks, you're going to see names that are interesting. You're going to see the Nasdaq, NDAQ. You're going to see TXN, Texas Instruments. You're going to see Tesla. You're going to see Pepsi, Johnson & Johnson. You're going to see both Googles or both Alphabets. You can see Clorox. These are you're going to see gold, physical gold sitting in a warehouse, right? These are different types of stocks that you add to a portfolio to increase the diversification. So, net, let me wrap this up for you. If you want to continue using SPY, you hold smaller optimized portfolios than if you use QQQ. QQQ is much more volatile than the SPY, almost 2x, and has a lower expected return in what I'll call real life applications. Oh, what was it? It was like 7.7% versus, I don't remember. Hang on. I never remember this stuff. I did remember. 7.7% versus, it was like 9.4. 9.1. Close. All right, and that's going to change the way you invest. Because if you expect less money back, you're going to invest differently, more diversification, right? And so that's the difference if you want to use one or the other. So that was the main part of this video. And I'm telling you that we're using SPY, but we're going to start holding a few more stocks that the QQQ likes. And we may actually offer two different portfolios. An SPY portfolio and a QQQ portfolio. Both hedged against the underlying index, or both hedged against the downrun stocks, which are the most volatile, the most crazy stocks, right? So that's how we roll. So let's take a look at where we're at. We're working on another little project. Maybe we'll take a quick look at the markets, and then I'll tell you about the little project we're working on. So if we look at the markets, you can see the S&P 500 is up 0.1 or 0.4. Nasdaq is up 0.14 or a third. So I think people like the fact that the S&P 500 right now is a less risky investment profile, And, I spend a lot of time looking at banks, so I want to share with you some data, which is right now, all of your bonds are down. Mortgage-backed securities are down today. The 20-plus year bonds are down today. All the bonds, U.S. Treasury bonds, are down today. Yields are up except for the 13-week, which is just hovering right around 4%. And so you see stocks that should be a great buy right now because they are richly valued for growth and excitement. Mixed to lower. And so we pull this list together based on some underlying research we do, and we're doing that research today. So I'm going to show you some of that research. So you better keep watching. So I find this interesting, though, right? All these stocks, right? How they doing? Because bonds are continuing to go down in price. Look at that. The 30-year is down 4 basis points. The 10-year is up 4 basis points. The 10-year is up 5 basis points. The 5-year is up 6 basis points. The 2-year is up 5 basis points. And so that takes bonds down. It makes bonds less valuable. And, so here's the portfolio for the S&P 500. It's got a few extra stocks in it, but it's okay. So here's the SPY one. And if you click on the change, you see a couple of down. Lots of them are up. Small numbers, though. So small moves. You look at QQQ. Oh, I never entered them. I'm sorry. We'll have to add that later on. If I look at the hedges, these are not all hedges that we hold, but these are hedges. You see some of them are down quite a bit. Some of them are up. And unfortunately for us, 3 of the ones that are up the most are actually the hedges that we chose today in our model. So our hedge is actually going to lose us money, while hopefully the market makes us money. And in fact, you see the S&P 500 is up. So the S&P 500 will also lose us money as a hedge. So had we have picked other ones like Carvana or Everbright or AMC or Desktop Metal, Peloton would have made some money today on the hedge. So we'll see how it ends. You never know until the day is over. Chips and semiconductors are always an important industry to look at. And here you see mostly green, a little red. Crypto and miners, physical miners. You see physical miners are up. They're actually, for the most part, they're up. Doing okay. Bitcoin, mostly down. Just is the way it is. And I go back to the banks. I'm always curious because here you have bonds down. So what happens is when banks make investments, they hold them. They hold them maybe to maturity. And if those investments go up in price, they go up in value, the equity of the bank goes up. The bank itself is worth more based on how the investments are valued. It has to do with like solvency, right? So a bank that is insolvent means it doesn't have enough assets to pay for all its liabilities. It is a money-losing situation, right? And so, because you never know, right? People have deposits in a bank, but they might see the same article that I saw and decide to take their money out of the bank. Let's see if I can find that. There is a particular article that I saw that would scare me if I'm a bank. Here we go. This bank is offering a $1,500 bonus for opening a new account. And it's not the only one. Banks are offering lucrative cash bonuses from $100 to $2,000 for moving money. And these are not necessarily, I looked at the article, these are not necessarily small companies. These are not fly-by-nights. These are big banks, the best ones. There's a credit union, it's fine. BMO Harris, Discover, the card that pays you back. CIT Bank, they're a commercial lender. Regions Bank, now that's a big bank, right? Citigroup. SoFi I never heard of. TD Bank, which is Toronto Dominion, big bank, right? Huntington National Bank. And I know there's others. There's Goldman Sachs. There's all these other banks. And so here's the thing. You get cash deposits, plus you get a really high interest rate. Why wouldn't you move your money? I'm not married to my bank, neither are you. You don't really care. You could order some new checks, right? When's the last time I even wrote a check? Let me look. I want to say it's like 6 months. Oh my God. One checkbook, and it goes all the way back to 2019. So it's not like you're married to the bank because your checkbook is something you use every day. I maybe use 100 checks a year. Maybe I use 20 checks in a year. It's awful, right? You give a Christmas gift, you write a check. No, normally you send money or you get a gift card or you buy them something. You buy them online, they ship it to the house. So there's no reason not to switch, right? And so if you're a bank that has a lot of deposits and a lot of investments, while the investments are going down, you are actually losing money. Now, I know they say that it's not true. So what they'll say is, look, I'm a bank. I bought in December of last year, I bought a bond at, I don't know, let's pick a price, right? I bought a bond at 160. I got a good deal, right? Now the bond's trading at 120. I lost $40. I lost 25% of the bond in 11 months. You lost money. You lost 25%. I got to tell you, my investments aren't doing much better. But there are banks that put a lot of money into bonds and are down 25%. Now, maybe they bought the 10-year note. Maybe. So how'd they do? Well, in December, they would have paid, let's say, got a good price, 130. Now it's 110. They lost $20 on 130. They lost 15%. Still a lot of money. Right? They're supposed to be making money on these investments. Let's look at the 5-year. December, again, maybe they got a good deal here. They paid 120. Wow. No, they didn't pay 120. They paid 121. Did great. Now it's 106. They lost 15. They lost like 8 or 9% on a 5-year note. So this is awful. These are banks losing their shirt, living on deposits that other people are offering $300 to $2,000. Big bonuses for new bank accounts. And so I would say, I don't know, if you're a bank and you're living on deposits and you're running out of money in the bank, meaning you have no assets, you have no value, that your assets equal your liabilities, then how are you going to keep going? So you're not. So what's going to happen is you're going to either have to sell more stock or get a government bailout or sell bonds, something, right? Because if the depositors start to leave, you're going to pay more as well for new deposits to replace the old deposits. You're going to squeeze your bankers. You're going to have them go out and find hot money, maybe even foreign deposits, to keep your bank afloat. Maybe you're going to find sovereign debt funds, right? Maybe Russian money. But I don't want to be relying on that. So as a bank, if you bought at 160 and you're holding at 120, You sure like everyone else on Twitter that I see that's lost 20, 25%. I lost my butt in the market, my personal investments. That's why we have a hedged fund or a managed account, which is directionless. That's actually doing well, right? But here, you're making a bet and you're losing your tuchus here. That's Yiddish for butt, okay? So, Jeffrey, where are we? What are you thinking here, right? Where are we at? Well, the banks, the regional banks in the U.S., haven't actually gone down in price. When you look for a year, you looked at sure, right? You kind of look at the average here. They were at maybe 70. And now they're 63. They're down 10%. Banks are down 10%. Doesn't really make sense. Banks are only down 10% for the year. Bonds, they're down anywhere from 8 to 20%, 8 to 15, 20%. But the banks themselves, doing fine. In fact, since March, they're only down about 10%. So banks are holding their own. And that's because they can lend out at a higher price than they're paying in deposits. So what happens is, let's say you have $1 billion in deposits. Maybe only 25% beta. Maybe only 25% of those deposits require an interest rate. Actually, the beta is the amount of the change in interest rate that you have to pay out. So maybe 50% of the accounts have to have interest that didn't have interest before, and you have to hit them for like 75% of the actual interest rate that is market interest rate. And you do all that together and you add in there the non-interest bearing accounts. Now you're at a beta of 25.25. So the banks are making money because that beta is slower than people expect. People are not moving their money. They're not moving it as fast as you would expect. But banks will eventually have to pay the higher interest rates, and they'll make loans at the higher interest rates, like mortgages. A mortgage right now, who wants to guess? Raise your hand if you want to guess right now how much a mortgage costs on average. I'll guess 7.1%. 7.25%, right? So the average 30-year fixed mortgage is 7.25%. So I'm a bank, I borrow at 2%. Maybe I borrow 1%, and I make this mortgage. I love it. I'm making 5 points on the mortgage. But what really happens is the bank will borrow money at a certain cost. Oh, and this is an important chart I need to show you for Nasdaq, but we'll get to that. So how much does 10-year money cost me, Jeffrey? So I'm a bank and I borrow 10-year. I'm borrowing at 4.2. I'm lending at 7.2. I get a 3-point spread. Plus I got 2 points of points. So I make 2% of my loan, which is great, profit, right? I got bankers, I got offices, I got all that, paperwork. I take underwriting risk. And then I make 3 points on my money. I borrow at 4, I lend at 7. 4.2, 7.2. That's fine. That's the game, right? Now, Wells Fargo just announced that their mortgage applications were down 90%. So let's see if I can find that. So I'm not using information that's not public. I'm using all public information. Wells Fargo mortgages down 90. 5 days ago. CNBC. Mortgage volumes at Wells Fargo slowed further in recent weeks. The bank had 18,000 loans in its retail origination pipeline. That is down as much as 90% from a year earlier. 90%. 90%. So great, I'm earning 3% on my mortgage, but I'm only earning it on 10% of the mortgages that I made before when by the way, I still earned 3% and I still earned 2% of points, but on 10 times more mortgages. So the banks have lost a tremendous source of profit. So what else? Jeff, why are you talking about this anyway? Well, so I'm running a spreadsheet here, right? With the thanks to Intrinio, which is our market data provider. This was from the 4th. This was from Friday's run using the S&P 500. And what we do is we're looking at AOCI as reported, as held in the database. So there's some errors, but usually we have to go back and check, and there are maybe 10% errors. And then we look at AOCI as a proportion of net income and AOCI, or as a multiple of common equity, and we see who has the most AOCI, right? And then we also look at market cap divided by equity. So if you add up all the stock and divide it by common stockholder equity, then I know my cost of my equity. And if I reflect in there the cost of debt, I do total cap over equity. So now I'm looking at the total price of the company divided by the shareholders' equity. Again, not perfect, because a lot of these companies have on the books equity, things that are assets that they really couldn't sell, like a brand name or a factory. Who's going to buy some old steel mill, right? So I take it with a grain of salt, but I assume everyone's got the garbage in their financials. So these numbers are roughly speaking okay. And if I was going to put big money in a company, I'd have to do dig down into it research. So I'm looking for banks. Okay, and I go through and I'm looking for banks. So here's First Financial Bank Shares, FFIN. So just to show you, I'm not a mean-spirited guy. I'm going to show you that FFIN, and I'm not faking you out here. No pump and dump. Actually, not at all. Why would I? Stupid. You and I both know the market's big enough to take care of itself. So FFIN is the first bank that I have in my really good banks. Really good. FFIN. It's down 2 cents today. FFIN trades, I mean, hold on to your hat, right? FFIN is trading at 4.6 times equity. 4.6 times equity is like, it's very rich for a bank. It's very rich. And so we're scrolling around looking for other banks. And I could do this a little bit with you. I really only want banks. I don't want lenders. Because lenders may have some leverage, right? But these are banks. Banks are regulated. Banks have a certain way of doing business. It takes you a long time to get to another bank that's as valuable as FFIN. But we're looking. Oh, there it is. There it is. Oh, no, hang on. Let me keep looking. I don't want to miss one. The second most valuable bank in the United States, Cullen/Frost Bankers, trading at a whopping 3.8 times market cap to equity. And if you take into account their debt, they have two kinds of debt, by the way. They have preferred stock and they have actual debt. And they went out and borrowed money. Isn't that crazy? $100 million. What the hell did they do that for? To buy more bonds? Pumpkin. Cullen/Frost. Company's my cat, by the way. Cullen/Frost borrowed $100 million, yielding 5.2% to buy bonds that are yielding 3%. I thought they were smart. I thought they were a bank. Right? Come on. And people are willing to pay almost 4 times common equity. Now, to be honest, I got to tell you, there's some goodwill from some purchases they made of other banks. So actually, the tangible equity is smaller. The other thing I want to point out to you is that AOCI, they're down $1.5 billion. Now that's after tax. They get tax benefit. So it's like $2 billion. They've lost $2 billion on their investments. It's like a $50 billion asset bank. And they lost $2 billion. Well, if interest rates keep falling, there's not a lot of equity left. There's only 2.667. And that includes goodwill. So what happens? What happens when interest rates continue to fall? By the way, Jeffrey, that's not fair. It's not fair. Why do you think interest rates are going to fall? Jeff, look at the trend. Interest rates are not falling. We'll just look at the 30-year. Come on, Jeff. You're pulling on my leg here. Oh, wait. I'm sorry. Interest rates going up. Interest rates really are going up, Jeffrey. Do you know a year ago they were less than 2%? Oh, went down to 1.67. Another 4.28. I don't think they're going down anytime soon. Look at the trend. Trend is definitely your friend. Rising interest rates. By the way, the Fed says I'm going to raise interest rates. I love interest rates. I'm raising them up. I'm going to fight inflation. And so if I were to draw a line, and I'm not a smart guy, let's try this. Let's do a regression line. I heard there's this thing called a regression. Let's try it. I'll go, this is on the yield, 30-year yield. That's a pretty straight regression line. Now, it goes up kind of fast. It comes back down. It loves that line. Look at that line. That's a beautiful line. So that would say that yields are probably going to keep going up on the 30-year, which means Cullen Frost's probably going to keep going down when it comes to their equity valuations. So you have FFIN. You have Cullen Frost. What about some of these others? Jeffrey, don't be unfair. I haven't finished yet, so we can do this together. I got time, right? I'm going to do this anyway. If you want to watch the video, you're going to learn something. Oh, wait. One other thing. While they're losing $1.5 billion, they did make $500 million. So they make $500 million. They lose $1.5 billion. I read somewhere, I think it was an SEC filing, that they gave a raise to one of the senior executives, and they gave out like a lot of stock options, incentive pay, stock grants, stock options, stock grants. I don't know, but it was incentive comp because they had such a great year. I gotta tell you, if I were to call up my honey right now, my wife, and say, honey, so I made $500,000 in the market in working, but I lost $1.5 million on our investments after tax. It was actually $2 million. So I made $500,000, but I lost $2 million in net worth. What do you say about that, honey? Oh, well, but people believe in you, right, Jeffrey? They believe in you. They're willing to pay 4 times what you're worth. Yep, 3.8, 3.9. That's right. So Jeffrey, I think it's great. As long as you can keep up good impression, and you can have them willing to put $4 for every $1 you're worth, I'm feeling pretty good about that. In fact, I might give you a raise and a bonus. You lost $2 million, but AOCI, get over there, right there. But you made $500,000. Yeah, so, honey, I gotta go. So here's the problem. Honey wouldn't say that. She would say, Jeffrey, I'm a simple woman, right? Let's add it up. Plus a half minus 2 means at the end of the year, I'm minus 1.5. And in the case of Cullen Frost, I'm minus $1.5 billion. Billion with a B. I don't think that lasts. So what's the next bank? Maybe there's another one. I used to look at other banks too. Let's see. Oh, it takes a while to get to one. Commerce Bank Shares. Commerce Bank Shares is trading at 3.6 times earnings. Their common equity is $2.35 billion. And their market cap's 8.4, so pretty rich. Their AOCI is minus 1.1 billion on a common equity of 2.3. So it looks like they lost about 1/3 of their common equity this year too, and earnings of about $500 million. So that's another one where I'm a little nervous on this one, right? So I'm going to give it a green. Green is good. Very expensive bank. Let's see what else we have. Gotta have some more in here, right? I love it. Now, the truth is, you see stuff like Hormel Foods and Hanes Brands because you can't value these corporations the same way you value a bank. See, the bank only has asset valuation, net interest income, and maybe some other income, but not much. It's hard to make money as a bank other than like on fees. Oh, service first. Here we go. Yes. That's another one that's on our list. That's a healthy valuation. Let's take a look. 3.2 times. I'm gonna keep going. So funny, you never know what bank is gonna come next, right? Takes a while though. The most expensive banks are really expensive. Wow. Okay, I'm a little uncomfortable. Raymond James is an investment advisory shop. Oh, Bank of Hawaii. That one. I know that one. 2.7, 2.8 times. They lost only $500 million in AOCI, but they only made a quarter. So that's not bad, actually. They made $250 million. They lost a half. It's roughly 2 to 1. That's not so bad, right? I don't feel as bad, right? It's not like they lost a third of their equity. I get the shivers when I say that. There are banks that have lost a third of their equity this year because they were caught. Okay, so this is another one. Bancorp, the Bancorp. And so this is what we do. We go through and we identify out the banks that have really this is not a US company. That's okay. We find the banks that are super expensive. And then we go back and we read the 10Qs and we read the 10Ks and we make sure that it's not just a data error, but it really is a problem, right? An overvaluation. And then we have to decide, are we going to make an investment? And so I want to show you something. I want to show you our website. If you click on our website, chicagoquantum.com, and you were to go to, there's the first page, but you have to go deep a little bit more right here. Stocks held by advisors, you'll see that we are long Verizon calls, we are long Corbis common stock, we are long Qubits or D-Wave warrants, and we're short CFR common. So, full disclosure, all the time. We haven't changed those positions since October. We're probably not going to change them for a while. They're hard to hold because what happens is they lose money. So service first, you see that FFIN? You see Bank of Hawaii, Cullen Frost, BANF, Bank First. There's others. We'll have to redo this list for the most valuable, the highest valuations, both on just equity and then equity and debt. And see, where are the banks that have the highest valuations? And maybe those are banks that you should avoid. So that's a bit of research we're doing. That's important. So to come back, what did we learn? So on this call, I said the S&P 500, or the SPDR, is a traditional index that you would use to assess stock market volatility and to find edges in the market. So this is our S&P 500 portfolio. I'm not going to guarantee you this is perfect. I'm not going to guarantee you this has all the stocks that we're holding or not holding, but it's a representative list. It's a good list. If you look at the QQQ portfolio, QQQ is much more volatile and in fact has a lower expected return and a lower price and actually has been dropping like crazy relative That was a chart I wanted to show you. Relative to the S&P 500, excuse me. I'm going to rebuild that chart for you. So here's the Nasdaq composite. Comparison. S&P 500. Make it gray. I like gray. Now you see, for most of the time this past year, those numbers were in lockstep. But right there at about October, they started to diverge. And in fact, I know now that the variances of those two exchanges, those two indices, have diverged. The variance of the S&P 500, which is the lower one, the variance is almost double the variance of the S&P 500. And so you can also see that the return is about twice as bad as well. Twice as much risk, twice as much negative return. The proportion about holds, which is scary because this shouldn't be a law. This shouldn't be something that is this simple. This is not okay, people. Because variance usually tracks liquidity, right? Low liquidity means it's more expensive to get in and out of a stock without... It is more expensive to get in and out of a stock. It is harder to get in and out of a stock without the price moving. And so the QQQ has greater volatility, which implies sort of lower liquidity, higher risk, lower price. And so I look at this and I think, if ever the liquidity were coming back, the QQQ would be a more attractive investment than the SPY. But as of today, just know that you're in trouble. You're in trouble if you put money in the QQQ relative to the SPY because there's a lower expected return and it is more difficult to trade it. There's more volatility. There's more stress, right? That's why the price is lower. That's why the return has been more negative. And so, maybe one other chart. So, Jeffrey, you just talked about liquidity, right? What does that mean? So, to me, liquidity means how much money is on the bid and the ask. How much money is available to be buying and selling stocks so that it could be a smooth market. Well, this is total assets held by the Federal Reserve. Now, the Federal Reserve should be one of thousands of players in the market. And so the question is, does the Federal Reserve mirror or reflect what the private market is doing? It may not, but it might. The Federal Reserve holds 31... That's not true. The Federal Reserve at its peak held about $9 trillion worth of assets. The U.S. federal government has 31 trillion in debt outstanding right now. So, and about 27% of the total assets held by the Federal Reserve are mortgage-backed securities. So figure you're at 6.5 on the treasuries out of 31. Okay? And that means you're at the peak, about 2.5 trillion of mortgage-backed securities. So they're selling off their treasuries. And if you look, you went from about 9 to about 8.7. So about $300 billion has been taken out of liquidity. That might be enough to actually change the game, to actually make the stock market more variable, less liquid. And so when I look at the two stocks that I have a big position in, I don't even look at Verizon anymore. I'm so sick of Verizon that I want to vomit every time I think about my investments in Verizon. I lost so much money on Verizon that I might as well work for AT&T. That's how bad my Verizon investment has been. It is the worst investment I've ever made in my entire life, Verizon. because Verizon acts like a bond, and just like bonds I showed you, bonds go down when interest rates go up. And so this is what it is. Suck it up, buttercup, right? So let's take a look. So this is Corbis. This is a crap stock, right? It's biotech, like zero revenue, losing money, painful, right? But you look and you see that the top of the book, we're just going to look at market value. That's it, just market value. Top of the book. And then we're going to look at market value of Cullen Frost, which of course is one of the stocks that we have a position in. And we find very interesting to think about. And so the top of the book of Cullen Frost is $500 ask, $21,000 bid. And for Corbis, it's $39 bid and $26 ask. So if there's not market movement, you're shitting me, right? I would put 25 or 50 grand to work in Corbis, or 25 to 50 grand to work in Cullen Frost, and you're going to move the market. You're going to hit about 10 price points. Here, you could hit 50 price points. You just can't trade this market. So now let's take a look at big. Let's go SPY and let's go QQQ. These are the main things that you would trade. And so here you see 300,000, 250, 70,000, 40,000. Okay. Here you see 400,000, 500. Now you see 150, 150, 200, 300, 5,000, 350,000, 26. So there's not a lot of money on the bid. 2,000, 39,000. Okay, 684, 200,000. All right, 916 underneath that 26. So you get a couple $100,000 maybe, but there's only 37, right? So it's up and down. There's not a lot of liquidity, right? I would think that if you were trading the largest indices, the most important indices in the stock market, the Nasdaq and the S&P 500, there should be a lot of liquidity. I don't see a lot of liquidity here. Let's find another stock. What would be another stock that should have good liquidity? To be honest with you, I don't know. So let's take a look. I'd love to have the audience give me a stock. Let's go to Finance Home, Markets, Most Active. I don't know. Some of these are like weird. So let's look at Apple, AAPL, and Tesla. Those are pretty fair. So Tesla, 20,000, 3,000. 20,000, 3,000. 40,000 to buy. Okay, so 22, 20, 20, 100, 23, 33. And if I look at Apple, 15,000, 41,000. Okay, 343,000, 68. 49, 27. So you're looking at maybe 50-50. For Tesla, it looks like it's like 9 and 3. Okay, so 3 and 60. So there's moves. It's like there's not a lot there. You have to go all the way down to this price to get $1 million in the market, and 1.3 million here, and that's down a whole bunch of ticks. So you see $1 million's going down and 1.3 million's coming up. That thing might actually get hit. And so there's not a lot of liquidity. And so I can't imagine if you're trading Apple that, 100 grand it could probably not going to move the market, but $1 million, $2 million probably move the market. 10 million, definitely. There's not a lot of liquidity. So I go back to Corbis, and I think I could move the market today. or Cullen Frost. 1,000 shares, right? Buy or sell 1,000 shares, it's $150,000. That's not a lot. Like, that's not a lot of shares that are on bid and ask here. And this is just ridiculous. $100, $100. I mean, come on. I might as well go and buy $100 worth of shares just to move the price up, so I can feel good that the stock is up a quarter or whatever, quarter of a penny. It's fake though. There's no liquidity. That's my point. And now if we look at QQQ and go back, just to show you kind of what I'm trying to say here, and I look at the spider, and I see that so look, QQQ, $2,654, the top of the book, 11,000. Okay, fine, it went to 44.56, it went to 23.20, 7,300. Now we're back, 250, 250, 250, right? 260, 30. It's not a lot of liquidity, and there's moments when the liquidity drops to under $10,000, top of the book. This is just nuts. So I'm not surprised that we see stocks moving. So let's take a look at FinViz. And if you look at the market today, down, up, down, it's not much. But how much are we really moving here? We're moving 20 points up and down. That's 0.5%. And on the Nasdaq, we're moving from 10,500 to 10,400 is 100 is about a 1%. Yeah, it's about a 1%. Those are some pretty big moves, 1%. And it smooths out. See the Dow is just straight up climbing. You got stocks down 90%, 20%. What's interesting is you look at the market overall and it kind of makes sense, right? So utilities are down in part because interest rates are up. I get it. Banks, hard to know. It's not really a straight movement. Tech is mixed. So Amazon and Tesla, but I don't know why, right? Nike, Starbucks. Why would Nike and Starbucks be down and Amazon be down? Maybe it's an Estee Lauder. Maybe it's because retail's looking a little painful. But Costco's down, Walmart's up. Again, not consistent. What I see consistent is utilities are red, energy's green. So my guess is that energy prices are up today. Let's go take a look. Jeffrey, how are energy prices? They're down. Well, they're up. Whether they're down a little bit right this second, they're up. They're looking good. They're not quite back to 100, but that's pretty healthy, between 90 and 100 on energy prices. So it's just hard to know, right? Is there news? Something going on, right? I don't know. So net, liquidity's dropping. Top of the book liquidity is dropping. Seems to be lower than expected. You look at stocks that we follow. Look at that. Look at that. $630, $1,000. That's less than 10 shares on the sell. On the buy, less than 10,000. It's less than 100 shares. So top of the book is really light. 100 shares, maybe 100, maybe 110. Really light. This is a really light book. And so there's no liquidity. And total shares is 8,500 shares, 7,800 shares. If I were to do a quick math on that one, this is a company worth $10 billion, right? $10 billion. We're gonna go 8,000 shares on bid and ask. And we'll give it a $160 valuation. It's a $1.28 million book on either side. So $1.3 million. Bid and ask. And that's how the stock kind of rolls. And you'll look, if you kind of watch, you'll see a lot of movement during the day. Because I think that $1.3 million is managed by an automated system. If we look at the time, let's see if we could just look at time. Same here. Well, let's look and see if things change. So if I look at Corbis, I don't know what the refresh rate is on Nasdaq live data. So there's that. But I'm pretty sure it refreshes quickly. So we look here and you see top of the book's moving. Top of the book's moving within 1 minute. So there's movement. My understanding is that movement is to move the market in the direction desired by either the market makers or the people with the big positions. I look at Corbis, there's no movement. Nobody cares. Tiny stock. $100 this way or that way. Yeah, $25 and $70. Yeah, that's great. Great, Jeffrey. No movement. But you look here, you see a fair amount of movement. Most of the sell orders have been replaced in the last minute, and most of the buy orders, the top of the book is within the last half a minute. So there's a lot of movement top of the book. It's almost like they're sending out messages, right? They're signaling. Buy, sell, buy, sell. Here's $1,000, $2,500, $2,800, $157.51. It's a lot of signaling. Not a lot of signaling on the Corbis. Let's look at the same thing now with the S&P 500. I mean, maybe I'm wrong. Maybe everything is signaling, right? So if I look at the spider, yeah, brand new. Top of the book is all in the last minute. Top of the book, a lot is all in the last minute, but not all the sells. So what's interesting is they're getting around the sells. The sells are a little later, right? So what happens is people put a sell order in and somebody sells a penny or two cheaper, right? It's just like they're playing games. They're front running a little bit. That's okay. That's a lot though. Look at those buys. Those are all 5 minutes past 2 o'clock. Wow. It's a lot of movement. This market is moving fast. So there's not a lot of money at play, but maybe they're making up for it with the quickness of the order, enter, order, cancel, order, enter, order, cancel, order, enter, order, cancel. They are throwing orders in there like crazy. Top of the book in the last seconds. 8 seconds. What are they doing? I'd be exhausted if I had to type those in all day. Hey, honey, I'll be right there. I've got to enter and cancel 4,000 orders in the next 1.5 minutes. No. So, of course, computer trading algorithms. And then somebody puts in an order. Somebody normal. A human. Let's look. There's an order from a human right there. $378,000 they want to sell. They're never going to be able to sell. What's going to happen is they're going to have to lower their price to sell. $189,000 to sell. 100. Look at that. I don't even understand. It's gone. It's probably moved all the way down the book. There it is. Oh boy. Like 20 people got ahead of that order. That's why it's hard to make money in this market, right? You put an order in and the market trades away from you just because the order's in. Look at that. From 1.5 minutes, 2 minutes ago, and it's all the way down here. That's nuts. And they got the same order up here. So what's happening is they're going to sell ahead of you, sell at a lower price. And then when you go to sell, they're going to buy yours. And they're going to make like 5 cents or 10 cents, whatever. They're going to do that all day long. They're going to beat you. Beat you, beat you, beat you. You think it's great because there's a penny spread, but you can't actually get executed that fast because the computers are trading this fast. What I find interesting is, why would Cullen/Frost, which traded 14,000 shares on the Nasdaq exchanges, have the same type of algorithms? And why are they doing it with 1 share, 2 shares, 5 shares? Who's running this show, right? At least with Corbis, if you want to piss your money away, go ahead. No one's playing a game here. You see it. There's $25 for sale. You want a $25 worth of stock? They'll give it to you. Since 1240, the same $25 worth of stock. So ridiculous. I'm gonna go buy it because I want those shares. $26 worth. But not Cullen/Frost. Cullen/Frost, they're selling like crazy here. It's like I'm going to a flea market that's mobbed of people, but not 1 share has actually traded since we've been watching. And I guess that's the point, right? Not 1 share has traded since we were watching. And yet the market, it's moving. And so at some point, you're going to see, right? Yeah, 2,500 shares traded, 2,500 shares traded. A big moment there. Looks like 6,164 shares traded. Tiny trades on the day, 109,000 off an average of 400,000. Market's up a little. Who even knows what's going to happen? I feel like this stock is just managed. This is a managed book on Cullen/Frost. And so I guess you have to be managed to maintain a valuation. This is what I should be writing articles about. You kind of have to manage a book to have a bank trading, just a regular bank, a top 50 bank out of Texas, at 3.8 or 3.9 times total common equity, that has lost $1.529 billion in the past year off the books, AOCI, after tax, so 40%. So call it $2 billion. They lost $2 billion. They made $500 million. They lost $2 billion. They made $500 million. They raised their dividend. They have a stock buyback program. They gave out raises, and they're giving out incentive compensation to their executives for having such a great year. And I look at it, and actually the expected return on this stock is 8.5%. This stock is expected to make money for investors. This is a good stock. The beta of 0.88, right? It's going to move less than the S&P 500. It's worth $10 billion. Cash flow of $635 million. So do you know that they said they're going to put another $1 billion a quarter into bonds? But look at that. AOCI is 313% of net income. AOCI is almost 60% of common equity. They're losing it all. Do you know this bank was started in like the 1800s? And they have lost probably 1/3 of their equity this year, 9 months. 1/3 of the equity's gone. God, those Confederates or Union soldiers that came and decided they wanted to start a bank in Texas be rolling over in their graves. How could you piss away 1/3 of the value of the bank? What did you do? Who gave you the right to do that? Right? I'm just looking at it. But yet, there goes the stock. Oh yeah, let's manage that book. Okay, so it's 1:12 Chicago or 2:12 Chicago time. I'm gonna take a look. And there it is. You got a buy order in there. You got a sell order in there. In the last 10 seconds, 20 seconds. All right, so that's the research we're doing. Looking at banks, looking at losses on assets. Losses on assets. Now, the good news is Cullen/Frost hasn't lost a single penny and hasn't accounted for a single penny of risk on their loan book. I guess there's no recession in Texas. Now they're doing consumer loans, they're doing mortgages, and they're doing commercial loans, C&I, and commercial real estate. And they've had no losses in 2021 and no accounting for credit losses in 2022. They actually have less money on the books to account for losses and a lower percentage because the loans have gone up. So they've made more loans and they have less money to stand behind it. And so I love it. I love it. Cullen Frost is a Cinderella story. The last time I heard a story like Cullen Frost was very exciting. It was a Cinderella story. So I want to thank you for watching. I just shared with you a lot, actually. I'm very excited to share with you what I do all day. I look at Corbis and I think, oh, maybe I buy a few shares. I look at Cullen Frost and I think, oh, maybe I sell a few shares. And I make videos and I put stuff on the website. In fact, I have a whole bunch of data that I could add to the website right now around what we have research that we do, and we have market information, negative beta stocks, top dividend stocks, all kinds of things that happen in the stock market. And we typically show it by positive net income stocks and negative net income stocks. And sometimes we have ETFs or synthetic investments. And we share with you so that you know, right? Here's what's going on. I think it's good that you know what's going on, right? And so the last time we did a thorough update was October 28th. For those who buy or run, you actually get all this. For $750, we'll give you our entire market analysis before the market opens. Sometimes we can get it to you the night before. Other times it's first thing in the morning. But it's early. It'll be like 5, 6 in the morning, so that you have time to look and to see what am I going to do here, right? What I got portfolios and I've got different things and got all this data about stocks. I love it. So that's it. Hope you liked it. Hope you liked the video. Hope you learned something. And thank you for watching. And you take care now. Bye bye.